What is the substantial presence test for immigrant taxes? Imagine you are visiting the United States for a few months each year and wondering if you need to pay taxes like a resident. That's where the substantial presence test comes into play. It helps the IRS decide if you should be treated as a resident for tax purposes based on how much time you spend in the country. If you meet this test, you will need to report your worldwide income, just like a U.S. citizen. If not, you will file as a non-resident alien and only report income earned within the United States. The test looks at your presence over 3 years, including the current year and the 2 years before. To pass, you must be physically present in the United States for at least 31 days during the current year. But that's not all. You also need to have a total of at least 183 days over the 3-year period, calculated with a special formula. You count all the days you were in the United States this year. Then, you add 1/3 of the days from the previous year. Finally, you add 1/6 of the days from 2 years ago. For example, if you were in the United States for 120 days each year for 3 years, your total would be 120 plus 40, 1/3 of 120, plus 20, 1/6 of 120. That totals 180 days, which is just under the 183 days needed to meet the test. So, in this case, you would not be considered a resident for tax purposes that year. Certain people are exempt from counting days toward the test. For example, diplomats with O or G visas and some students or teachers on F or J visas during their first 5 years in the United States are not counted. This means they are treated as non-resident aliens for tax purposes during that time, even if they are physically here. Understanding the substantial presence test is especially important for Latino families and immigrants. If you meet the test, you need to file taxes as a resident alien and report all income from anywhere in the world. If you do not meet it, you only report income from U.S. sources. Sometimes, tax treaties between the United States and your home country can change your residency status or tax obligations. These treaties can sometimes let you be treated as a non-resident, even if you meet the test, which could lower your taxes. Knowing how the substantial presence test works helps you stay compliant with U.S. tax laws. It also helps you understand when you need to file as a resident and what income you need to report. This way, you can avoid surprises and take advantage of any exemptions or treaty benefits available to you.